All right, friends, welcome once again. So we're wrapping up with the basic mechanics. Okay, we're wrapping up with the basic mechanics. A quick look through what we've done so far, and then we'll wrap it up with the final version. Okay. So once again, I'll quickly run through everything from the scratch. Okay, I'll run through everything from the scratch. Okay. All right. So this overview, what we are looking at, we've looked at goodwill computation using alternative approaches, how to value the NCI using its proportionate share of the identifiable net assets of the subsidiary, or we can even value the NCI given that if we know the market value of the shares and the shareholding that the share and the structure, the group holding structure, okay, or the percentage that the NCI holds, we can easily value that one. And also identifying the net assets. Now, this is the next item which we are going to focus on. It's fair value. Okay, this fair value. This is the last item. So we want to just run through the rest, what we've done so far, the pro forma workings and everything. Okay. Group reserves, we'll come back to it because once we deal with the intra-group trading, provision for unrealized profits, even with a fair value adjustment of the assets, it has some link with this one. Okay, so this guy has some link with this guy. So we'll come to it. Goodwill at fair value, at proportionate value. We've looked at example how to determine how to calculate this. Okay, so quickly running through. So the basic mechanics, the five standard workings, in no particular orders, establish the group structure, identify the acquirer, identify the purchase price or determine the purchase price and the acquisition date, very important. And then the second mechanic is to look at um, recognizing and measuring the fair value of the identifiable net assets of the subsidiary, okay, with the format there. Whatever we get, whatever items we get at acquisition is what we transfer to what? The goodwill computation. And then the post-acquisition element is what we split between the NCI and the group's reserve. Okay. Then we looked at how to recognize and measure these identifiable assets and liabilities of the subsidiary. Okay. Make sure that it meets the asset meets the definition of an asset, even if it's an intangible asset, make sure it can be measured reliably. Even if the subsidiary had internally generated this item and did not recognize it, once we acquire it as a parent company and we can measure it reliably, we need to recognize it. If it's a liability other than a contingent liability, let's ensure that it meets the definition of a liability as per the conceptual framework. Number three, we look at goodwill, its valuation at fair value, at proportionate share. We have a negative goodwill, which is the same as bargain purchase. Okay, we credit it directly to our income statement. So we looked at example of goodwill computation. Okay, using both elements. Okay, yes, using both elements, looking at the fair value and then the proportionate. Remember, goodwill is not amortized. We'll check for impairments. We check for impairments. Then number four, we look at the NCI's calculation, how to measure it. So usually it's fair value at acquisition, and then we look at that any component in terms of its post-acquisition reserves of the subsidiary, their share of any impairment losses. Okay, any impairment reviews. Impairment losses is just almost the same thing. Okay, to get our NCI at reporting date. Two alternatives for computing our NCI at proportionate share of the subsidiary's identifiable net asset or at fair value. Or sometimes we may be asked to compute it ourselves. Okay, so we have an example here, NCI and goodwill, looking at both alternatives. Okay, alternative one and then alternative two. Okay, fair value, proportionate share, fair value, proportionate share. All right. Then we look at the next item. We look at the next standard calculation, which is the consolidated reserves, the basic format. We'll still look at an alternative presentation format, okay, and we can adjust this more. At this point, our illustration, our example covered only these two elements, okay. But we could have this, we could have this, we could have this, okay. and then we adjust all of these. Let's move on. All right, so we took a simple example of Pepper's acquisition of Source. Cash consideration, we paid 19 million straightforward. No need to find the purchase consideration. And we worked through everything. Okay, there was an impairment review on the goodwill. NCI at acquisition was 2 million, and we looked at this. Okay, and then we moved on looking at the basic guiding steps that we need to follow. Okay, in no particular order. You just choose which one helps you. So we look at the question that I just showed to you, and we work through everything. Okay, and then we go to this section where we finished up the calculation. All right, and then we moved on to look at NCI's valuation at fair value, at proportional, at fair value method and proportional, and sometimes we may even be asked to compute it ourselves to find the NCI. Okay, so we took this example, we identified and determined, and we said in relation to the company's adoption of IAS 8, they will decide, choose and pick which one they think is feasible for them, whether they should whether they should recognize NCI at proportionate or goodwill at proportionate method, or NCI at fair value or goodwill at fair value. Each depends on the company. All right, so in a question, in an exams, we will be clear which one should you use in terms of determining the NCI fair value. Okay, all right. And then we went on to say that, listen, it's not always straightforward and straightjacket where they will give you the price that the parent paid. Sometimes you'll be asked to compute it. And that's where students always get confused. We always get stuck to cash paid. So when you go into the exams and you see that it is not cash paid, but it is a deferred cash, it is a share acquisition which has been issued, or deferred shares, or there's a contingency, contingent liability, contingent recognition that you need to do, we get confused. We think, no, it's not possible. All right. The accounting entries were quite straightforward. In all of the cases, we'll always debit the cost of investment. Then the credit element will move on based on the elements under consideration. We looked at this, we looked at this, and then we took an example, a typical example, where we were asked to find the fair value of consideration paid. Nobody gave it to us. And so one, it was share, 2 for 3, right? So again, in all cases, it is the shareholding of the parents. You can decide to just find 60% of 100,000, okay? To simply say 60,000, okay? 60,000 as a constant, okay? 60,000 as a constant in all the cases, okay? 60,000 as a constant. And then you work it 2 for 3, and then you move on to the current share price, okay? To the current share price, right? 100 for 500, okay? So 100 for 500, okay? Is that it? I think that's all straightforward. Nothing more to adjust here. And so again, this is at 1.21, okay? Deferred cash and then times the discount factor, all right? Times the discount factor. Time value of money. And then the discount factor is the cost of capital we use. It can be discount rate, rate of return, market yield, yield to maturity. Anyone they use, simply consider it to be the same, okay, for now. And then we have the market price of the shares currently, not the issued, not the par value, okay. So we took this, we looked at example, we worked this, okay, in the previous video, okay. And then we came to look at fair value of consideration. Another example, just to move on. Cash was paid, right? And then 2 for 5, okay? And then we have 2 for 5 here. And then deferred cash in 3 years, time value of money. Cost of capital, 6%. We adjust everything, right? And then we got this. The next thing, fair value of assets. Fair value of the subsidiary's net assets. Sometimes you find it, the book value of what we acquired is different from the market value, the fair value. If you go to the market and check, you benchmark the values in the subsidiaries books against the market is different, okay? So we always need this, okay? Where assets and liabilities are not carried at fair value, we need to adjust them. Let's ask where and when necessary. Look at the book value, look at the carrying amount, okay? And compare it to the fair value on the market. So we need to adjust it on workings 2. Workings 2 here, I'm talking of our identifiable net assets of the subsidiary. That's the first thing we need. So we need to take care to complete both sides on the assets and again on the other elements of the workings. Okay, so you realize that when we take the workings number 2, it affects some portion goes to the NCI, some portion go to the group. Okay, some portion goes to the goodwill computation. So make sure you adjust both sides where necessary. And typically, fair values will cover the non-current assets, PPE. Okay, PPE. So any adjustment to this PPE must reflect any post-acquisition depreciation affecting this one. Okay, at the reporting date column of W of the identifiable net asset calculation for the subsidiary. Okay, we take an example, you get it easily. Again, current assets could be affected. So look at the inventory. If inventory is affected, we need to provide this adjustment to inventory. Again, in the reporting date column of any inventory sold in the post-acquisition period. Okay, we take an example, you understand it. And when we deal with the intragroup, you better understand it, you get it better. Intangible assets, which the subsidiary did not recognize. Once the parent has acquired it and can measure it reliably and has paid consideration for it, we need to recognize it as part of the subsidiary's net assets. That's the interesting part. Subsidiary cannot recognize it because it's an internally generated brand. But once the parent is taking over the subsidiary and has paid a fair consideration, we need to consider that as part of the subsidiary's net assets. Any contingent liabilities will not be recognized by the subsidiary, and therefore it will need to be deducted from the net assets of the subsidiary. Okay, then we can insert it on the consolidated statement of financial position to reflect any post-acquisition adjustments as necessary. Don't worry, it may sound more technical. You will find it to be very easy once we take an example. It's very easy actually. Now, any adjustment in the reporting column must be included in the statement of financial position. Any in the reporting column, in the reporting date column, must be included as adjustment on the face of the financial position, statement of financial position. Example, like I said. Okay, so now we work in this example, and I'll take my time. So on 1st October, parent secured 80% of the 20,000 ordinary shares. We are dealing with just the fair value adjustment of the net identifiable asset of the subsidiary. No goodwill calculation here, no NCI calculation here. We just want to focus on only the workings number 2 per this particular format we've used. So the identifiable net assets of the subsidiary. Okay. At the date of acquisition, the balance on the subsidiary's accounts retained earnings was 24,000. And then the subsidiary earned a further profit post-acquisition of 12,000. Okay, so you realize that pre-acquisition or at acquisition was 24, and then post-acquisition was 12. So overall, on the reporting date, you would have seen this on the books of the subsidiary. It would have been what, 36. Okay, you'll see this there. During the year ended September. Okay, let me just check. From October 2016 to September is 1 year. Exactly, right? At the date of acquisition, the fair value of the PPE was equal to its carrying amount in the books, except that there is one plant which had a fair value of this above its carrying value, its carrying amount. This we need to adjust. So we are being told that there's a fair value which we need to adjust upwards because what is on the carrying amount is lower by 6,000. At that date, the plant had a remaining life of 4 years. Therefore, even though we are going to recognize these, we must adjust. They said it's using straight line depreciation. Okay, the 6,000 fair value must thus be divided by the useful life of 4 years, right? By the useful life of 4 years. Okay. For plant, assuming a nil residual value, there's a nil residual value. Okay. So this one will give us our fair value depreciation. Okay, our fair value depreciation, which needs to be adjusted. All right. Also, at the date of acquisition, the parent company valued the subsidiary's customer relationships as intangible at a fair value of 45. So the subsidiary wouldn't have recognized these intangible assets. It's an internal brand they've generated, good customer relationships. Sometimes it can be customer list, okay? They cannot recognize it. But once the parent has acquired it, he's able to measure it reliably at a fair value of 45. The subsidiary has not accounted for this asset as usual. Trading relationship with the customers of the subsidiary lasts on average 6 years. So again, we need to then amortize this intangible, right? 45 by the useful life of 6. Okay, by 6. Okay, let me work this and put them down. So our 6 by 4, just to be very sure, okay, is 1500 for the depreciation, right? And then our 45 by 6 gives us 750, all things being equal. Okay, so that is amortization and this is the depreciation. Okay, prepare the working number 2 for Sujay's net assets for inclusion with the preparation of the parent's consolidated statement of financial position. Okay, so this is what we're going to be dealing with. Anything anything odd here? No, everything looks straightforward. Okay, straightforward. Okay, so this is the solution. We worked it out. Okay, so remember, in the first instance, we acquired 80% of the 20 ordinary shares. So you remember that in the first instance, what we will deal with in terms of the subsidiaries' net identifiable assets is to pick out its equity shares. Everything. Okay, so that's the 20,000, which still remains at the reporting date, and there's a nil element at the post-acquisition. Again, I showed you at the date that we acquired it, the retained earnings was 12. It was 24,000. Okay, the retained earnings of the subsidiary was 24. Now we were told that after acquiring it, it made extra 12,000 at post-acquisition. It means at the reporting date, it was 36. Simply our 12 plus our 24, right? Fair value of the plant above its carrying amount was 6,000. Same, it will be at the reporting date, nil for the post-acquisition. Okay. Then remember the fair value was depreciated 4 years. We showed it there, right? 4 years. Okay. 1,500, 4 years. So we subtract. It's a depreciation. And it must be carried over to the post-acquisition elements. Okay. The reason why we're bringing it here is because, remember, risk and rewards, we share it with us, with our NCIs. Okay. The fair value of the customer list, which the subsidiary had not recognized, we must recognize it. Okay. And it must also occur in our reporting date. But again, the fair value must be amortized over each useful life. We said on the average, it is what? The average is 6 years. So we got 750, which we computed. Okay. Again, it's more like a reduction, an amortization. Okay. We subtract. Okay. That is all from the details here. Nothing so complicated. We are not being asked to calculate the NCI. Okay. But you can easily calculate the NCI if you want to. If you want to use the proportionate. Okay. 20% of this, assuming the market price of the share is 1. If the market price of the share is 2.5, it will simply be our 20% of this 20,000 times that to give us our NCI component. But nobody's asking us to compute the NCI here. Goodwill, we cannot compute goodwill here because we don't have the purchase consideration. The question is so silent on that one. We are just interested in looking at the identifiable net assets of the subsidiary. Okay, so that's all. So everything here, when we sum it up, is what will take us into the calculation of our goodwill. And everything here is what will split. The NCI will end up taking what? 20%, and the group reserve will take 80% in terms of the structure, the holding. Okay, all right, very easy. Very easy. Let's wrap it up. So at this point, given this, I will ask you, attempt the TYU question 4 on chapter 18. Okay. And please take your time, study the text, practice more examples, okay? And you can easily get the IFRS 10, IFRS 3. Also, if you could find and read any what professional bodies have said about these particular two standards, especially IFRS 10, the advantages, the disadvantages, implementation issues, okay? And dwell more, find some time to read your ACCA text by Kaplan, chapters 17 and 18, all right, to get more insight. Okay, all right, so I've not ended yet. I've not ended yet. I've not ended yet. This is the same thing we've looked at. I'm going to present the same thing again. Different example, different, not different format, but the same format, the same logic, the same understanding, different approach. Okay. Choose which one best suits you. I will still emphasize this. Choose the one which is okay for you. If this is okay for you, please stick to it. If the one we'll be looking at in the subsequent video, I'll make it 2 videos, okay? Please pick that one, okay? If there's any other logical, sequential approach you've seen in any text that you're going to be using, please use it. Use it. The only thing is when presenting your statement of financial position, that one we know it follows a standard presentation format. That we have to, but for the workings, feel free. Do what you think is best for you, okay? And at the end of the day, we want you to feel happy. Don't think that I need to strictly find 1 plus 1 to be 2. No. You can find 5 minus 3 and it will still give you 2. 3 minus 1, it will still give you 2. All right. Okay. Good. I'll see you in the next session. Bye for now.